Silver has been one of the biggest surprise winners of 2025. It's more than doubled in price, outperformed gold, beat the S&P 500, and even left tech giants like Nvidia in the dust. By late November, silver hit an all-time high above $57 an ounce. Just weeks later, it pushed past $70. So here's the question. After a run like that, how could silver possibly still be undervalued? The answer lies beneath the surface. Let's break it down. 1. A supply shortage that isn't going away. This isn't a temporary bottleneck. The silver market is heading into its 5th straight year of deficit. In just the last 5 years, the world has used nearly 1 full year's worth of global silver production more than it mined. And it's projected to get worse. By the end of the decade, mines may only be able to supply about 2/3 of global demand. Why can't producers simply ramp up? Because most silver isn't mined on its own. It's a byproduct of copper, zinc, lead, and gold mining. That means even if silver prices soar, supply can't respond quickly. Add in aging mines and a lack of major new projects, and the pipeline looks structurally constrained. In other words, you can't just turn on the tap. 2. Industrial demand is surging. Silver is no longer just a store of value or a jewelry metal. It's becoming a backbone of the modern economy. Solar power alone has transformed the demand picture. A decade ago, solar used about 1/10 of the world's silver. Today it's close to 1/3. And newer high-efficiency panels actually require more silver, not less. Then come electric vehicles. EVs use far more silver than traditional cars, in batteries, power electronics, and charging systems. By the end of the decade, EVs are expected to dominate automotive silver consumption. And then there's AI and data centers. Every server, every chip, every power connection relies on silver's unmatched conductivity. As global computing capacity explodes, so does the metal's industrial footprint. All combined, industrial silver demand just hit record levels and is projected to break new records again this year. 3. The gold-silver ratio is flashing a signal. For centuries, investors have compared silver to gold. Today, it still takes roughly 65 ounces of silver to buy 1 ounce of gold. Historically, that ratio has often been lower. In past bull markets, it has compressed dramatically, meaning silver outperformed gold by a wide margin. If the ratio merely drifts back toward its long-term averages, silver would need to rise substantially from current levels. 4. Physical silver is getting scarce. Paper prices can move fast. But physical metal tells the real story. London's vaults have seen massive drawdowns. At one point, inventories fell so low that traders were flying silver across continents just to meet delivery obligations. Borrowing silver overnight briefly carried interest rates that would normally be associated with distressed debt. Similar drawdowns are being seen in Asian exchanges. When physical supply tightens like this, it creates a natural floor under prices and increases the risk of sharp upside moves. 5. Big money is stepping in. This is no longer just a retail trade. Sovereign buyers have begun adding silver to reserves. Major ETFs have seen inflows far above expectations. Institutional capital is positioning silver not just as a precious metal, but as a strategic industrial asset. Historically, when governments and large funds move in, it tends to happen early in a structural cycle, not at the end. 6. The macro environment favors hard assets, inflation pressures, rising debt, geopolitical instability, and central banks shifting toward easier monetary policy. These conditions have traditionally favored tangible assets, and silver has often outperformed gold during such phases. Lower interest rates reduce the opportunity cost of holding metals. Currency debasement fears increase their appeal. Silver sits right at the intersection of monetary hedge and industrial necessity. 7. What could drive the next leg higher? The bull case is built on a simple foundation: structural supply deficits, exploding industrial demand, tight physical inventories, institutional and sovereign accumulation, and a supportive macro backdrop. Some analysts and investors are already targeting 3-digit silver prices over the next cycle. 8. The risks. Silver is volatile by nature. It reacts not only to monetary policy but also to economic growth. A global slowdown or renewed interest rate hikes could trigger sharp pullbacks. And when silver moves, it moves fast, in both directions. That volatility is the price of admission. Final thought. Silver may have already doubled, but the forces reshaping its market are long-term, structural, and still unfolding. This may not be the end of a rally, but the early chapters of a revaluation. Silver has always earned its nickname as the devil's metal, unpredictable, explosive, and capable of rewriting expectations. For those who understand the dynamics at work, that volatility isn't a warning sign. It's the opportunity.